Hey traders, Money Badger here, and I'd like to welcome you back to Badger Trading University. If you haven't already joined the BTU Discord, simply click the link in the video description below. In this video, we will develop an understanding of moving averages and how we can use them to identify possible trading opportunities. More specifically, we will take a look at both the simple and exponential moving averages. As illustrated in the chart shown here, moving averages help to filter out the noise from random price movements in order to provide a clearer picture of the market trend. Moving averages are considered lagging indicators since they are based on an asset's past prices. Notice how the peak of the moving average develops only after the peak of the price action. Moving averages are used by traders to identify current trends and confirm trend reversals, as well as provide dynamic support and resistance levels. When price action is above the moving average, an asset is considered to be in an uptrend, and conversely, when price action is below the moving average, an asset is considered to be in a downtrend. Additionally, a breakout above or below the moving average can often confirm trend reversals. And finally, moving averages can serve as dynamic support levels during an uptrend and dynamic resistance levels during a downtrend. In a trending market, when a candlestick closes above the moving average following a downtrend, it produces a buy signal, and when a candlestick closes below the moving average following an uptrend, it produces a selling signal. Traders can use these signals, along with other technical indicators, chart patterns, and candlestick patterns, to enter or exit positions with more conviction. Let's take a look at the simple moving average, or more commonly referred to as the SMA. The SMA illustrates the average price of an asset over a specific period. For example, a 50-period SMA takes the closing price sum of the most recent 50 candlesticks divided by 50, giving each candlestick equal weight. When a new candlestick forms, the oldest one in the period is dropped. Now let's take a look at the exponential moving average, or more commonly referred to as the EMA. While the EMA illustrates the average price of an asset over a specific period, recent price action is weighted more heavily, allowing it to respond quicker to price movement. This is where the EMA mainly differs from the SMA, which weighs all price action equally. An important decision traders must make when choosing to use either moving average is which period will work best with their trading style and strategy. Since one period is equal to one candlestick, a 50-period SMA or EMA illustrated on a 1-minute chart will look much different than a 50-period SMA or EMA illustrated on a daily chart. As a general guide, a day trader typically uses shorter period moving averages, such as the 9 and 21 periods, and swing traders or position traders generally use longer periods, such as the 50, 100, and 200 periods. On the chart shown here, both the 9-period simple moving average and the 9-period exponential moving average have been plotted, both of which have advantages and disadvantages. The main advantage of using EMAs over SMAs is that it reacts quicker to price changes, ultimately reducing lag time and providing traders with a better idea of the most recent price trend. However, this is also its downfall. As the EMA responds quicker to price action, it can often give traders false signals when looking to enter or exit a trade, as the EMA may whipsaw with random price movement. The main advantage of using SMAs over EMAs is that it provides traders with a more clear and smooth look at price action and helps to avoid those false signals, which may allow traders to remain in a position longer. The downside to this is that compared to EMAs, SMAs tend to have a longer lag time, which may translate to entering or exiting a position late and possibly even missing a trading opportunity altogether. So how do we know which one to use? Well, it ultimately comes down to personal preference. I would argue that one is not necessarily better than the other, but that they're both equally valuable to traders and can find their rightful places among different trading styles and strategies. If you currently use or are planning to use moving averages, comment below which one you prefer and why. Thank you so much for watching. If you enjoyed the video and maybe even learned something new, please like, subscribe, and join our Discord by clicking the link in the video description below.